Entering the second half of 2026, retail investors are caught in a crossfire between a hawkish Federal Reserve and an AI-driven market frenzy. The market is currently reeling from the inauguration of the new Fed chairman, Kevin Walsh. His stance is significantly more hawkish than his predecessor, and his silence has triggered widespread fears that a major rate hike cycle is imminent. This lack of clarity creates a climate of extreme anxiety. When every news cycle contradicts the last, investors often feel forced into making impulsive, emotional decisions that can ruin a long-term portfolio. Our analysis suggests that hitting a year-end S&P 500 target of 8,200 is not a matter of luck. It requires us to ignore the shouting on financial news and focus exclusively on the specific data signals that Wall Street is mispricing. To navigate the months ahead, you have to be willing to look past the panic and understand the core macroeconomic forces that are actually moving the market. The single biggest risk right now is the Federal Reserve's recent projection. They expect core PCE to end the year at 3.2%, a rise from the first half, which suggests they believe inflation is actually accelerating. But the data tells a different story. The inflation we saw in early 2026 was largely driven by a massive surge in oil prices during the recent conflict, which impacted everything from shipping to consumer goods. Look at the actual price of WTI crude futures. Since the peak of the war at $110, prices have tumbled down to $68, nearly cut in half in just a few months. This supply isn't slowing down. As shipping lanes reopen, massive volumes of oil are entering the market, and U.S. exports have surged from 3 million to 8 million barrels per day. This robust supply side is effectively turning energy from an inflation threat into a source of deflation. We see a similar trend in housing. Zillow's rent index, which typically leads official government data by 12 months, has been trending downward for a year. This guarantees that the largest component of core inflation still has significant room to fall. With energy prices falling and rent cooling, the threat of more rate hikes is likely overblown. The actual data shows that inflation is under control, meaning the primary risk factor for a market crash is rapidly dissipating. The next major source of noise is the November midterm election. With Donald Trump back in the headlines, the market is bracing for heightened policy drama and potential trade disputes. While volatility always spikes through October in election years, the most likely outcome is a divided Congress. Historically, a Republican-led Senate and a Democratic-led House create the kind of legislative gridlock the market loves, as it prevents sudden drastic changes to the tax code or business regulations. Underneath that political friction, the U.S. consumer remains remarkably strong. We are seeing a K-shaped economy, where high-income wealth, boosted by a 2-year bull market, is driving record-high spending that more than offsets the squeeze on lower-income households. Mastering these market anomalies is exactly what we teach in the SFA Free Stock Investment Masterclass. We break down institutional data so you can spot these opportunities before they are priced in. You can find the link right below in the description. Political uncertainty is a short-term hurdle. Once the election results are in, the market typically rallies as risk is released, supported by a consumer base that is much more resilient than the headlines suggest. In the tech sector, we are currently stuck in what I call existing pool logic. It's a zero-sum game where companies are fighting over a limited supply of resources like chips and power. This has been great for chip makers, but it's creating a bottleneck. Cloud providers are spending billions on hardware, but aren't yet seeing the massive revenue growth to match that expenditure, leading to extreme market tension. That logic is about to change. With the rollout of agentic AI, tools that actually perform tasks rather than just generating text, we are moving towards an incremental growth logic. This is where AI applications start generating massive new revenue, which then flows back through the entire value chain. This shift will broaden the market rally. Instead of just a few semiconductor firms winning, we will see the benefits spread across software, services, and the big tech giants that are finally monetizing their massive investments. However, you must be aware of the immediate trap. If big tech giants decide to slow down their hardware spending, the semiconductor sector, which is currently priced for perfection, could see a significant correction. Ironically, a slowdown in that spending would likely boost the stock prices of the big tech companies themselves. It would relieve the pressure on their profit margins and prove they are prioritizing returns on their capital. The best way to handle this is not to guess the timing, but to hold companies with unshakable technological barriers. If you aren't sure which ones to pick, A broad index like QQQ allows you to capture the growth of the winners without the risk of picking the wrong individual stock. The real fuel for the year-end rally is earnings. Forecasts for the second half of 2026 show corporate earnings growth jumping above 20%, nearly double the historical average. This is the direct result of AI-driven efficiency gains finally hitting the bottom line. If you want to learn how to identify the specific companies that are leading this efficiency revolution, join us for our masterclass. We'll show you the exact metrics institutional investors use to separate the winners from the hype. This target isn't based on a parabolic bubble. Currently, valuations are sitting at a 5-year median, meaning the market hasn't actually become more expensive this year, even as it rose. Combine that valuation stability with a 20% earnings acceleration, and the math suggests the S&P 500 is positioned to reach 8,200 by year-end. Stay focused on the data, and we'll see you in the next video.